Hello, everyone, and welcome to the Saigal Sea Trade podcast. I'm research analyst Trisha Mohite, and I'll be the host for today's episode. And today we're diving deep into the turbulent waters of global oil markets. Well, April 2025 brought dramatic shifts that are reshaping the shipping industry, energy markets, and the geopolitical landscape. And who better guide us through this complex maze than someone who's been navigating these waters for decades? So, for that, I'm thrilled to welcome Mr. Sandesh Ghandat, who is a market expert and commodity expert, and will be joining us today. So, welcome to the episode, Sandesh.
Thank you, Trisha, for having me. Always a pleasure to be here and discuss these fascinating market dynamics that are kind of unfolding before our eyes.
All right, Sandesh. So, let's start with what's got everyone talking. There are whispers that Saudi Arabia might be considering an unprecedented $10 per barrel hike in their official selling prices across all the markets. So, if this isn't just market noise, it could reshape global trade flows overnight. So, what's your take on this bold move?
Well, Trisha, the possibility of $10 price hike is kind of exactly what keeps oil traders up at night. So it's not just, unprecedented. It's potentially market shattering. But to understand why this matters, we need to look at the Saudi Arabia's position on the global chessboard. So let me give you some facts. So the kingdom currently directs about 70% of its exports to Asian markets. And when we are speaking of Asian markets, we are talking about China, Japan, Korea, India. Those are the primary nations. So these relationships, they aren't just commercial, they are strategic. When we look at the current numbers, Brent crude is currently hovering around 74.95 per barrel, and Saudi's Arab light to Asia already commands $3.5 premium above Oman Dubai average. So they actually reduced this by cautious 40 cents in March, and which tells me they are testing waters and seeing how elastic demand really is. So let me put this into the historical context for you. So back in 2020, Saudi slashed the prices by $6 to $8 per barrel, depend upon who is purchasing. After Russia refused to cut production, and what happened? You know what happened? Brent crashed to $31.02 per barrel, and it was a bloodbath. Then in 2014, they tried to crush US shale producers through the predatory pricing, flooding the market. And you know what? That strategy ultimately backfired as American producers, they kind of responded with efficiency gains of 30-40%. So they didn't kill the shale, they made it very stronger. So the question is, why would they even consider such a massive hike now? So it comes down to their dream of complete pricing power, something they have pursued for decades. But here is the reality check. We are looking at the global inventories that tell a different story than the one Saudi might want to believe. And what that story is, OECD stocks. They increased by 11.2 million barrels in January. Now oil on water, that's the crude in floating storage or in transit, or it kind of rebounded in February. So these aren't indicators of market that can absorb a $10 price shock. And I'm talking this very carefully. This $10 increase will be a price shock for the not just suppliers but also the buyers, because for them the prices will be increasing substantially. Now, having said that, let's look at the US supply and US production. It is kind of a breaking records. We have Atlantic Basin and Brazil. So Brazil's Bacalhau field is now online, and then we have a Kazakhstan. It's Tengiz is flooding in the market with fresh barrels. So we have three different countries. Those are kind of backing the production and backing the supply, increasing the supply in the global market. So we project kind of a 3 million additional barrels per day in 2025. And the IES forecasting is a kind of a potential 600,000 barrels per day surplus this year. So that's not the production deficit that would justify kingdom size of price ambitions. Now China is another critical factor here. Once the engine of global oil demand growth at 60% in the previous decade, it now contributes to kind of a modest 19% in 2025. Here is what's fascinating. So their hunger for crude is kind of driven entirely by petrochemicals rather than industrial expansion. And that's a fundamental shift in consumption patterns. And you know what? That affect the tanker routes, cargo types, and ultimately the so-called pricing power. Now April isn't their peak domestic consumption period either, so that comes in the summer when Saudi consumption for cooling spikes to 770,000 barrels per day. So if they are considering this move now, it suggests that they are reacting to something else, and perhaps it could be a geopolitical pressures or budget concerns. So their current account deficit in 2024 and the balance of payments, they kind of a break even estimated around $90 per barrel, and it puts them in a tight spot. And I have just mentioned the current price, so it's a $16 difference right now. But here is the what shipping professional need to understand. Even the oil monarchs must bow to the market forces because it is supply and demand situation. So Saudi Arabia can influence the market, but it can't control it, and not anymore. The days when the OPEC could dictate the global prices through simple production cuts are long gone. We are in a new era of complex supply chains, alternative sources, and then kind of a market sophistication where extreme prices moves tend to self-correct through the demand destruction or competing supply. So in other words, rising this particular crude oil or this Saudi OSP by $10, it will self-destruct the demand and self-destruct the demand which isn't already there in the market. But having said that, we may think that this $10 price hike kind of a possibility. But personally, I would bet on more measured approach because this they will test the market with smaller increases, and they will watch carefully how the buyers will respond, specifically China and India. So for ship owners and charterers, this means volatility but not necessarily sustained higher rates. So the real question is how this affect the route economics in the future.
That's fascinating, Sandesh. You have truly painted a vivid picture of Saudi Arabia's dilemma, and it does seem like they are walking on a tightrope between asserting pricing power and the potential triggering market backlash. Now, I want to shift gears slightly. There's something happening in the oil markets that doesn't make headlines but fundamentally changes the game, and that game being the definition of oil itself. Now, you have mentioned that crude oil is no longer the whole story. So, can you break down this silent revolution for our listeners?
Well, absolutely, Trisha. This is perhaps the most overlooked transformation in the energy markets today, and it has a profound implications for shipping. Now we are witnessing nothing short of redefinition of what oil means the modern energy landscape. So here's the reality that most market analysts miss. So I am giving you some facts here. Crude oil's dominance has plummeted from commanding 90% of the petroleum landscape in the late 1990s to just 74% today, and that is a 16% drop. And you know what, that's an extraordinary shift, but yet it countless market analysts still treat black oil as the whole story. Now for the ship owners, traders and investors, this oversight isn't just academic, it's kind of a potentially costly. So let me give you some more numbers, that illustrate the scale of this transformation. Now I'm taking the example of United States. So United States, it's pumping a massive 13.49 million barrels of daily crude as of December 2023, and that number is still there as of April 2025. But that's only part of one story, or we can say that one side of a coin. They are simultaneously producing an additional 7.1 million barrels of natural gas liquids, that is NGLs, plus 1.44 million barrels of biofuels. And this particular production is not accounted anywhere. It's not crude, so they are not counting it. And this catapults their total production of staggering 20.6 million barrels daily. Now think about that for a moment. If US NGL production were its own country, it would rank as the world's fourth largest oil producer. Only US crude, Saudi Arabia and Russia, their total output would surpass it. So that's how significant this other oil has become. And that was our question, right? So what's particularly fascinating from a market manipulation is, our perspective is how OPEC nations have exploited a bureaucratic loophole. It was dating back to the East. So they have established the quota system that time, and their quota system is conveniently excluded NGLs, and not just NGLs but also condensates. So this allowed the OPEC members to technically honor production limits, while kind of a boosting output through these invisible barrels. So it's a masterful sleight of hand that has enabled OPEC, to offset a kind of a 2 million barrels daily decrease in crude production over, 2 decades with drafty 1.5 million barrel increase in the NGLs. Now, having said that, take the example of Saudi Arabia. So Saudi Arabia's development of Jafurah field, this particular field, it promises around 1 million additional daily barrels of quota-free liquids, that is NGL and condensate that we have just discussed. So these are between 25 to 2030. And then we have Nigeria. It has gone even further. Boldly, they are reclassifying some crude as a condensate to kind of a sidestep quota restrictions altogether. So it's a kind of a creative accounting at a national scale, but it kind of backfire OPEC in the long run. So the implications for the shipping are also enormous, because the different product requires different vessels and different handling procedures and even the different ports. So the traditional crude oil tanker fleet is still essential, but increasingly specialized carriers for LPG, ethane, and other products are kind of seeing a stronger demand growth. Now the companies that understand these shifts, they are kind of positioning themselves accordingly. So investing in versatile fleets, that can handle this evolving product mix. That should be the projective, and that should be a priority objective. Now, having said about the production, consumption patterns are also changing, because now petrochemical inputs now drive over 50% of global petroleum demand growth. And we, with the ethane, propane, and butane, they kind of accounted for around 40% of projected increase. We know that China and other countries, they are increasing the capacity of PDH plants, and it requires more ethane, propane, and LPG imports are also rising. So that is a kind of giving a statement where we can say that there could be projected increase, but these increases will be coming from non-crude oil liquids. And this isn't oil being burned or for transportation, or power isn't, it's becoming plastics, chemicals, and materials. So these particular trade patterns and shifting routes and ultimately vessel demand, they are kind of a changing, and that change is necessary. Now let me give you a concrete example of how this affects policy and markets. So when we talk about proposed 10% universal oil tariffs, so many analysts, they miss the cascade of market distortion this creates, because heavy crude, it is coming from Canada and from Latin America. It will be available at the heavy discounts to other markets, and those other markets will be Asia, and in Asia it would be particularly China and India. Now it is a benchmark New York Harbor refined product margins, they kind of are jumping by $6 per barrel, and significantly higher US retail fuel prices, particularly on the east and west coast. All because different petroleum products are treated differently under these particular policies. Now, even more dramatic is what we are seeing with the Russia's sudden reduction of Kazakh oil shipments via the CPC terminal. Now, it was Kazakhstan is saying it was mainly for safety issues. So this coincides suspiciously with the unwinding of voluntary production cuts. It was a kind of a geopolitical chess move between Trump and Putin, with real world consequences for global supply chains. Now Kazakhstan has been clever about this, stepping up production to 8.95 million metric tons in March. That is equivalent to 2.17 million barrels per day, and edging up from February's 0.15 million barrels per day, which kind of a technically maintaining its OPEC plus crude quotas of 1.468 million barrels per day. But how? By boosting condensate production, which remains conventionally exempt from the quota restriction, and is the same playbook others are also using. For the ship owners and charterers, understanding this new reality isn't optional, it's essential. The vessels need for transporting ethane are not the same as those carrying crude oil. The routes are different, then the terminals are different, then the economics are also different. So those who continue to think in terms of simple oil tankers are kind of missing the complexity of today's petroleum logistics.
Well, thank you so much, Sandesh, for giving your analysis in such great detail. Again, it was great to have you here, but we'd end now for this part one of our episode. We'll see you again in another part, and thank you for today's episode.
Well, thanks Trisha for inviting me once again, and it is a pleasure to be here. Thank you.
Thank you so much, Sandesh. And to all our listeners, stay tuned for part two. And thank you so much for tuning in. And do not forget to share and subscribe to our podcast channel. Until next time, navigate safely and stay informed.